94. Welcome back. This is the City Breakfast Show. Your comments are welcome on 0549 986 996.
Some people got nothing.
Earlier in the show, I announced that we'll be having a very interesting conversation
Some people got weight.
concerning your investments, that kind of thing. Now, in the last few weeks, several agitations have popped up in the public space. People are wondering what to do with their money. Should I go for my investment? Should I let it stay put? People just want to understand what exactly is happening. Better than you remember when we spoke to the information minister,
Charlie.
we were asking questions about our haircuts. Will investments be affected or not? So we've brought two people who understand the space very well to give a lot of clarity
To break it down.
to break it down really, so people can have can make better informed decisions. Okay, so we have Reverend Daniel Ogbarmey Tetteh. He's Director General of the Securities and Exchange Commission. He's the big man there. So if the big man is here, it means that all your questions will be answered. We also have Mr. Kise Antonio. He's Vice President of the Ghana Securities Industry Association, and he's the MD of Sentinel Asset Management.
So this is the regulator,
This is the
and
regulator,
then this
this
is
is
the
somebody-
industry association.
Industry Association.
So everything they answer.
Don't answer. Gentlemen, good morning. Welcome to the City Breakfast Show.
Good morning.
I trust
morning.
we're doing well this morning.
Yes, we have.
fine.
Just good.
Wonderful, wonderful. Now we know that on the 20th of October, they issued a directive. It was a
I
think 6-pager.
Yeah, 6-page
It was a
directive.
6-pager that they put
With
out.
English,
there.
I couldn't understand.
Charlie, some of the things I read and read, I still didn't quite understand. That was
Them
great.
small.
And then on the S.E.C issued a public notice on the 4th of November,
Yes.
informing the public of its directive and circulated FAQs to
Yeah.
further get clarity on the matter. So let's start from this point. So help us understand, Reverend Ogbarmey Tetteh, help us understand what necessitated these actions and the rationale behind the two different pieces of information that you put out.
Okay, thank you very much, and good morning once again to your listeners and then your viewers on Facebook, I believe.
Yeah.
Let me start by reminding everyone about the mission of the S.E.C, which is to regulate, innovate, and promote the growth and development of an efficient, fair, and transparent securities market in which both investors and the integrity of the market are protected. I'm repeating this because anything we do is against that context. How do we protect investors? How do we protect the integrity of the market? How do we ensure a fair, transparent, playing field so that both operators and investors are protected? So that's the premise on which I want to make my submission. Now, when it comes to investment, because the directives we issued had to do with investments, in particular fund managers managing collective investment schemes. So when you invest, either as an individual or if you're a portfolio manager of a collective investment scheme, you buy securities. Okay. Now in Ghana, we typically have the two basic securities. There are a few others, but I'll limit myself to equities and then fixed income.
Okay.
Now, when you take equities, you have those that are listed on the stock exchange and then those that are not listed. But you find that most of the time, the collective investment schemes focus on the listed securities.
Okay.
Now, they are expected at the end of every trading day to indicate the value of the securities, and that determines how the portfolio is doing.
Okay.
Now, what I think people may not have averted their minds to is the fact that bonds or fixed income, which are listed, also have a price. Okay, and just as the price of securities, whether it's let's say Fan Mill, Guinness, any of the securities can move in a day, in a week, in a month, based on various investor sentiment. Bond prices also move, and especially when you have the situation that we have now of a bit of, if you like, instability on the macroeconomic front, leading to a surge in inflation, and then as a result, interest rates also going up. The relationship when it comes to bond, the price is inverse. So when interest rates go up, you find that the price of bonds it goes down. Okay, but what people must remember is that with a bond has a tenor. So let's say a bond may be a 2-year bond, a 5-year bond, a 7-year bond. It has a tenor. Within the tenor, the bond price can go up and down. It can go above the face value. It can also go down, and it reflects the current macro economic situation. Okay, but on maturity, the face value returns to 100%. Okay, but in between, that's the tenor. It can, it can
move up,
yes,
down. It can
yes,
change.
and the relationship with interest rates is inverse. So when interest rates go up,
bond prices go
down.
I see.
And then when interest rates also go down, bond prices go up. Okay, so that again is a premise. Now, what we expect is for fund managers to value their portfolios based on the performance of the underlying securities. Now, for those who manage equity funds, they always mark to market, as in they use the end of day trading prices to value their portfolios. But the practice for most of the fund managers with fixed income portfolios has been to hold to maturity, because typically they do not or they have a portion, which of the assets that is geared towards liquidity, and so they will hold to maturity, and they will be collecting the coupon payments over time and all of that. Okay, so
where the coupon is the interest.
Sorry,
I'm using a lot of terms. It's used equity. It's used bond.
Apologies.
Coupon. Whereas coupon is what you use to go and get fuel. So when you say coupon,
yeah. So that you get the interest payment that has been promised with a bond. So that hold to maturity approach means that you collect your coupons, but you don't necessarily value the portfolio looking at the prevailing market price. Okay. Now, in a situation where interest rates have gone up, and it means that the value of the bond price have gone down. If we do not mark to market, and then people will have to exit, assuming for whatever reason, either panic, they've heard some rumor that something's going to happen, and they want to check out. Then if you're not marking to market, number one, you don't let the investor see the value of his the investment. If he has to go out today, he sees the portfolio valued at the face value, which doesn't reflect
the current market conditions.
Current market conditions. So what we sought to do with this directive is to ask the fund managers that for your fixed income portfolios, market to market, so that the investors can see the value of their investment in the fund. Now, people need to understand there's a difference between unrealized gain and then unrealized loss. So, for instance, if I have invested X amount, 100,000, for instance, and today you show me the valuation that based on market conditions, my 100,000 has dropped to, let's say, 90,000. If I stay put and I don't panic, I don't jump up and down, wear a raffia skirt, and try and check out, and the market corrects, I don't realize the loss. So the loss is, if you like,
it's on paper.
The loss is on paper.
So it's unrealized. But if I get agitated or I'm desperate to move out and I check out, then I'll lock in the loss. Okay. But when we say mark to market, we are saying that let investors see that, well, at this point in time, because of market conditions, the value of your investment may have gone down. If you don't check out, you don't realize it. But if you check out, then you lock in the loss. But it's just to get investors to see the current or prevailing value of their investment, so that they make an informed decision. Actually, this will be a good time if you understand how investment works, to buy, because there's a principle of you buy low and then you sell high. So it's all about understanding. But we want the fund managers to reflect the current market value to their investors. That way, you create a fair basis of letting people appreciate the current value. So both those existing, those entering, those exiting, it's a very fair game.
That's funny, because that means that the question I asked you earlier, that what prices are coming down in Ghana, at least bond prices are falling. within the period. Because before you came, we were discussing in Ghana what is not going up, and we couldn't find anything. So at least we have our answer now. But my question to you though, okay, your explanation of this mark-to-market thing sounds logical. And my question, why hasn't that been the practice? Why did that require you to write a directive? Because it seems logical that if I go and buy something for 100,000, and the time I bought it, because I'm buying it at a price based on the interest rate, and the interest rates are always changing, why doesn't Kise and his people, or why don't Kise and his people say, well, when you want to exit, we will mark it to market? I think that, in fact, I'm told that in other markets, that's the way they do it. Why does he have to use what you call the hold to market, some people call amortization approach? Because it seems logical that in a market of varying interest rates, the price at the time that you are going to exit will have to be discounted on the basis of the price, not the original value you bought it. But you had to write a whole letter, put Q&A in there before they did that. Why?
No, so Bernard, you find that a fund manager typically will create a portion of the portfolio for liquidity needs and would invest that portion in, if you like, what we call near cash instruments to take care of
requests for
redemptions. And based on their strategy, they may decide to hold a lot more to maturity because they can receive regular interest payments over the period. Also, remember that unfortunately we don't have a wide investment universe which has a lot of, if you like, options or products that fund managers can get into. So typically you find people who they'll buy and hold because if you take corporate bonds, we don't have a lot of corporate bonds. So you find a lot of fund managers playing more in the government bond space where they they buy and collect the interest payments, and then on the maturity they reinvest. Okay, so and actually IFRS 9 indicates that based on your business model, your valuation model can also be tailored to reflect it. Okay, so that's that. But let me also say that actually there are some fund managers already doing mark to market. It's not like this is the first time that we are asking them, and I'm not referring to those managing equity portfolios. There are some fund managers managing fixed income that were doing mark to market. Yes, a few, because before we came up with the directive, we did a survey to confirm those who were already applying it and those who were not. So it's a mix of reasons. But given the fact that interest rates had gone high, we believe that it was important to step in to make sure that we protect investors, especially those who are entering and then those who are in, and so that people do not exit at elevated.
So are you saying that those who were exiting in an era where mark to market was not being used were going to disadvantage those who remain? In the sense that those who remain will be paying for the windfall that those who exit get?
In a certain sense, because those who are exiting will be exiting at elevated because so if beyond the proportion of your portfolio that you set for liquidity, now you have a lot of redemptions.
Means you have to sell.
You have to sell
to get money to pay the guy who wants to leave.
So if you have to sell, then you, because of the market conditions, you sell at a depressed value. So if you don't give that lower value, it means that somebody will have to be
I see.
Taking that.
So I mean, very interesting explanation. So is it in your space, is this the convention? Is it global best practice? Is this unique in Ghana? For those who are, because for a lot of people this is the first time they're actually hearing this. So is this something that pertains in this space? This selling at mark to market value, that kind of thing, valuing your portfolio.
Yes, like I said, there are portfolios already that are being marked to market. Okay. If we take those who buy equities, that's
so. Let's take it one. If you see when you say a portfolio, our listeners are wide. Okay. So let's get simple. So tell us, I have 10,000 CDs. I have come to Kise, and I say I want you to go and buy a mix of fixed different income things, and then some sort of balanced long-term thing for me. All right. So Kise says I'm going to use 4,000 to buy fixed income instrument, 20% a year. The rest I'll put it into some fund B. That after 10 years you can get something B. So when you say portfolio, which is the portfolio?
Okay. So when we talk about portfolio, it just is a term referencing what a fund manager, the different investment instruments that a fund manager will put together. You know, if we take your
My
portfolio,
10,000.
My 10,000.
you
I
have-
give him. What is my portfolio in the 10,000?
So if let's say you put 10,000 and let's say Kisa is managing an equity mutual fund, that's a mutual fund that invests in shares. Your 10,000 will give you shares in that fund that Kisa is managing. But Kisa would have bought maybe EcoBank, Stanchart.
These are shares.
These are
That's what you mean by
shares.
equity.
Yes.
Okay, so you would have used part of the money to buy that.
equity.
Yes. Now, if assuming it was a fixed income bond, a fund,
Yeah.
so Kisa may have bought some government of Ghana, maybe a 2-year
Treasury
bond,
bill.
a 2-year bond, 3-year, 5-year, 7-year, some treasury bill, maybe some fixed deposits with a bank. So basically, a collection of different fixed income instruments form the
So when you say
portfolio.
fixed income, is that a short term one or long term?
So fixed income covers both
Long and short term,
long and
depending
short, because the duration is fixed and whatever interest you get is also fixed. So for instance, if you take treasury bill, if it's a 91 day, it's fixed income because after 91 days the investment matures and you have a certain fixed interest.
Okay.
If it's a bond, a 5-year bond, it's a tenor is 5 years and the interest rate or coupon maybe maybe 7%. So when we say fixed income, it covers both the long and then the short. Okay, when you say money market, then you're referring to the short end, and there are some money market funds where they invest in instruments 1 year and below.
Okay.
So maybe a 1-year note,
I got
182. Yeah. So
So he will
basically
be my portfolio manager.
Yeah.
and he would invest your 10,000, your 5,000. He will invest in the different.
Okay. Again, before you go to what is a collective investment scheme?
The idea of a collective investment scheme simply is where a number of people come together, pool their assets together, and assign a fund manager who has the time and the expertise to select the kind of investment instruments that will yield some decent returns and enable them to achieve their goal. So you can have, let's say, an equity fund, mutual fund or unit trust, where the fund manager will just pick shares or equities. You can have a money market fund. And for instance, we would normally say that if you have an emergency fund, you put it in a money market fund because that one
More liquid.
It's more liquid. You know, and you can have a fixed income mutual fund or unit trust. So depending on the mandate of the fund, the collective investment scheme just says that pull your money together. There's a fund manager, and the good thing about collective investment schemes is that it's easy to enter and easy to exit because you don't need a lot of money to get in.
Great. Now let's move on to the thing that's bothering a lot of people. Okay, now this mark to market thing, how different is it from the haircut on government bills that's become really topical? Lots of people are asking whether or not is this the same thing as the haircut, and what's the so is this the same thing or this is very different?
It's not the same thing. It's totally different. And let me explain.
Okay.
With regard to, let me say, the speculation that has been going on around government debt discussions with the IMF, and therefore people saying there's going to be the haircut. I think we all listened to the president who came out to say that, you know, there is no haircut because a haircut was going to mean that probably people's I think the speculation was that your principal was going to be affected and so on and so forth. I think, you know, there has been that clarity. As to the details of the discussions, you know, regarding government debt, I'm not in a position to speak to the details because I do not have the facts. But this directive of mark to market is not a haircut conversation. What this directive is just saying is that create that fair a transparent basis of valuing your investment. Let investors appreciate the fact that currently, given the market situation, if you are exiting, you exit at this value. Let me give an example of using shares. If let's say you buy shares of EcoBank, you buy 10,000 at let's say 2 cedis, and you bought it maybe 5 years ago or 2 years ago. Now today you want to sell, and the price has dropped to 1.5. You can't go to the market and say they should sell it to you at they should buy from you at the 2 cedis you bought it. You sell at the prevailing price. So all this conversation about mark to market is to say that when it comes to investment, especially securities that trade, there's a price, there's a market price, and it's important to mark the current value to the prevailing market price, and that would inform you to make the decision that, hey, if I check out now, because of
effectively I make a loss.
Yes, but if I don't check out, then that loss could be wiped out. That's how it works. So it's just so this is not a haircut conversation. It's just to say that let's let the value of the funds we are managing reflect the current market position, and let the investing public appreciate that this is what it is. If I should check out today, I lock in the loss. Many years ago when I was on the other side, I remember I sold a particular product in a church, and there was the wife of the pastor who bought it, and then a few months after, the price dropped. You can imagine, I'm also a pastor, and it wasn't easy at all. But I managed to convince her that, look, market prices have that kind of a movement. So if you don't panic or get agitated and check out, it's the market has a way of correcting. Okay, she listened to me, and a year after, the price had gone up, and that I didn't hear from her again. But you see, it's just to let people understand that security prices, whether it's a bond or shares, it moves. So marking to market just gives you a better sense of the prevailing value of your investment. Yeah.
Mr. Ketteh, let me bring you in. Like I said, he's with the Ghana Securities Industry Association, so he's in the space. Actually, a player in the space. Now, how does the association view this directive from the S.E.C, and how are fund managers expecting investors to respond to this implementation?
Yeah, thanks. I think the members of the GSIA understand the reasoning behind the S.E.C's directive, and we believe that the market valuation methodology will, as Reverend was saying, protects the interest of all investors in collective investment schemes as they are treated, and I believe more importantly, equally in a market like what we are currently experiencing. Like Rev said, a good number of funds, and I dare say most, were hitherto using the hold to maturity valuation methodology, where they use the face value of those securities and their accrued interest over whatever period one was looking at to get the value of those securities. And like was being espoused earlier, if investors are coming out now using that methodology, they're going to get a more than a proportionate share of their interest in these CISs, and that will ultimately hurt investors that will be left behind. Regarding the second part of your question, based on this, we expect investors to stay invested, because it's important that you might get a statement showing a loss, but it is nothing but a paper loss. You only crystallize the loss when you exit that instrument. So for instance, you buy something at 10, now I'm telling you it's 8. It's a paper loss. You haven't lost 2 CDs.
Okay.
You only lose 2 CDs when you exit. So I'll advise investors to stay invested. And if you do not need cash don't just redeem for redemption's sake. Yeah, even at this time, maybe you need cash for something. It might even be good to consider other alternatives.
But I have a question. So you're saying, so let's say there are two possibilities. Some people have spoken to say, I actually needed the money at the time I came for it, and when I entered the investment, I didn't know that this man had told you anything. I don't know him. It's you I know. And then I was hoping that my 10,000 that I bought, the price would be 12,000 the time I exit. But then this man has sent you a letter that says that, well, if Bernard is exiting in November, the price is 8. Don't even give him the 10. Let him get it for 8. He feels hard done by. He says it's like you are changing the rules in the middle of the game. So I'm not happy with you. What will you say to such a person?
Well, you see, it's rather unfortunate, and I guess the strategy for most fund managers was to hold these funds to maturity. But we are currently in an environment which we all witness to. I mean, the monetary policy rate has increased by about 11 percentage points over, the last several months, and that has adversely impacted the prices of these bonds.
Okay.
So you understand. So I guess at the time of you coming in, we all expected that, look, we've pulled funds from various investors. We're going to hold these bonds to maturity. We're going to get coupon or interest, as you say, to come in to reinvest if interest rates were going up in higher yielding instruments to take advantage of those higher yields. And also, we keep cash when investors are coming to redeem, we give them. But currently, what has happened is we fund managers have been inundated with redemption requests, and
based on what? Is it based on the fear of a haircut?
No.
Or what was? Why are they doing that?
Before all this haircuts discussion started. Okay, like I said, the NPR went up, so interest rates on government securities.
So you mean the monetary policy rate went up?
Yes, NPR, the monetary policy rate.
Yes.
So interest on government securities also went up, and the interest on these securities were more than what these fixed income funds were offering. So,
people wanted to move their money into more
and then invest in higher yielding instruments. And then secondly, we all know that people were speculating on the CD as well.
So they were also removing their CDs
They were
to
removing
buy
their
dollars.
money to buy dollars.
So there was pressure on fund managers beyond the liquidity they had prepared.
So they've been inundated. I mean, there have been the outflows and the billions.
Wow.
Okay? So because they've been inundated with these requests, they need to go into the secondary market to sell.
To sell
they are
for the
not
guy
even
who's
getting
remaining.
inflows.
So let's put
You
it this way.
understand?
So I wanted my money now because I want to buy dollars. Nathan is there relaxed. But you have to sell what I want to exit.
Yes.
And the person buying it doesn't want to buy it at the high price.
No, but he can buy it at a high price.
Because the market is depressed.
Yes, because look, if there was a bond I bought a bond maybe a year ago at 20%, and now on the secondary market, the yield of that bond is in the mid to high 40s. If I need to buy your bond, I need to buy it at a price where the coupon I get and then the capital gains I make at maturity will be equal or more than what is currently the yield or the coupon or interest on what we call on the run issuances, which are the recently issued securities. So I guess that is the reason why if you invested with me and you come back now, I'll tell you that.
So the other question, sorry, so two things. Are you not selling products to people who don't understand what they are buying? Because the way you're explaining this thing, if I'm coming to give you 100,000 CDs, I should know that based on the interest rate, the price can rise or fall.
Yeah.
And that whatever I get, as you said, capital gains and then interest or coupon. It seems to me that a lot of people were buying these things
not knowing,
without understanding.
Absolutely.
In fact, this point you made about the price and the inverse relationship with the interest rate and the fact that it is what is the so-called par value. I'm sure 70% of your people don't even know what the meaning of those things are. But when they give you the money, you take it. Do you understand? So my question is, maybe you guys in the industry too, it's your fault. You haven't, because again, the point you're making about people all speculating and running.
Yeah.
Now, there's no industry that can withstand a run.
Yeah.
Now, a run is always based on information or
lack
fears.
of it.
So, again, I'm challenging you that maybe you guys in the industry have not educated your customers well enough. And that is why they are susceptible to whatever message. Somebody can put something on WhatsApp and people are all running because the guys, you are taking their money to do business for them, but they don't actually understand how you are making the money for them. And so, the least thing that happens, they do something and then you are hot. And then you have to call this man to come and help you.
Okay, I think that's a good point, Bernard. I mean, the thing is, prior to 2016, I believe, Rev, I guess I'm right, there was no secondary market for bonds.
So just a primary.
So it was just a primary market. So there wasn't a secondary market where you could sell. So I guess
So when you say primary market, you are talking about the main people, BOG, the big guys who buy from government directly. Secondary market is selling.
Fund managers to buy from government.
Yes, so
directly.
it's not everybody who understands the term. So I want to explain what's the secondary market.
Okay. But on the secondary market, that is where we can trade these instruments. So if I want to exit an instrument, I go to the secondary market, and that will be, for most securities, it's a function of demand and supply.
Okay.
I mean, even for fixed income securities, it's a function of demand and supply as well as interest rates, like Rev was saying. So prior to 2016, there was no secondary market. So all these fixed income funds were doing valuation on a hold to maturity basis. And I guess the rationale for most of them had to do with the fact that no one expected a run. So they expected that as people come in across the economic cycle, we can invest maybe when there's low interest rate regime, when interest rates start going up, we take advantage of new issuances, the yield on newer issuances, and conversely the same would be true, so that we are able to offer returns across, pretty decent returns across whatever stage of the economic cycle we are in. I don't think anyone foresaw what we are currently experiencing. And let me say, the hold to maturity valuation methodology too is something which is also used. I guess it depends on the strategy of the manager. But with the mark-to-market valuation methodology, it's the standard used, when you have financial assets or liabilities.
So is that going to be the
Fluctuating
permanent?
value.
So Rev, are you saying that
Going for it is
from
that
now
one.
henceforth is mark to market, or we are saying because of the current economic uncertainties we are doing mark to market, and then we'll do H to hold to market later
Hold to maturity.
and hold to maturity?
So there is a link to the business model. If you take, for instance, a money market fund where the investment is in fixed income securities a year and below, you find that mark to market it's not applicable. Okay, so what we are saying is that one, of course, your business model matters, but for fixed income portfolios, especially the longer end.
Yes.
You need to do the mark to market so that one, you can let the investing public also see the risk associated with that particular investment. And I totally agree that a lot more work needs to be done with the education, because I think people haven't been giving the understanding that even fixed income has some risk. So a lot of education needs to be given for people to understand how prices of securities can move and all of that. So I totally agree with you on that point.
Okay, some questions have come in. This one, okay, the first one I have here, somebody's asking if, for example, mutual funds, do they have a maturity date?
They don't.
Mutual funds don't have
They
a maturity.
don't. Now, each mutual fund or collective investment scheme will typically tell you that you can access your money either after this period, and if you put in your request, it will take maybe X number of hours or days. But with mutual funds, especially open-ended, there's in and out.
So there's no maturity date. So but that's why you need to clarify. Is when you use hold to maturity as the alternative to mark to market, I have a problem with that, because it depends on what I buy. I feel it's more accurate, and I'm not an accountant, it's more accurate to use a word like amortized value. Because if you say hold to maturity, if I'm in an open-ended mutual fund, there's no maturity. Or is there, Kisei?
No, so the maturity is in the underlying asset. So the mutual fund or unit trust will have a price. And the price is a reflection of the underlying securities. Now, some of the underlying securities would have maturity dates.
Some.
Because if it's equities or shares, there's no maturity date. But if it's fixed income, there'll be the maturity date. So the fund manager, maybe the strategy is holding to maturity
for that component of
component of the portfolio. But you, as an investor in the mutual fund or unit trust, you buy units or shares in the fund, which is.
You know why I'm worrying myself about this? You see, if I go and borrow money from a bank,
yes.
Why don't they also do mark to market? Because if I go for a loan of $20,000 to buy a house, okay, and you say the interest on the loan is 10%, because at the time I went for the loan, interest rates were at this level. I'm paying the loan over 20 years. At this time that I want to exit, maybe I decided that my mortgage is too high and I want to exit because the currency doesn't make sense to look for CDs. Why don't they also mark to market and say, well, at the time of exit, the interest rate has dropped to 4%, so we must reduce your interest rate? Why don't you do that? Do you understand? If you are using mark to market, I have invested, I have excess money, and I want to make money on it. And you're saying that when I'm exiting, you will mark the price that you sold
to the
asset to me at the current market rate. Interest rate is the price of the debt. So in the same way, if I go for a loan in a volatile interest rate environment, you should also be able to say, if somebody is paying their debt at a specific time, particularly for something like a mortgage, they should also mark the interest rate to market. Do you understand? But you don't do that.
Bennett, I think with banks, when they're given facilities, you either have a fixed interest rate or a variable interest rate. So I guess one could argue that the variable interest rate is the mark to market. So
but most banks will give you fixed.
Well, I guess then that is the banks,
Yeah, but,
so
but it's the financial sector. You see, the financial sector is under threat based on everything that's happening.
Yeah.
So the financial sector, because of the economy, is threatened. Yes, you are the S.E.C guys. So yes, some of these things are BOG issues. But I'm saying that if you want people to trust in the market, your pricing methodologies have to also be reflective of the times. Maybe this is not a forum for it, but you can't mark to market for my investment and then when it comes to the debt I go and owe you there, you are saying the interest you give me in 1945, I should still be paying. That doesn't make sense. So that one they won't agree.
Anyway, some questions. Yarintom is asking if there's going to be haircuts on BOGT bills, and how will it be done? How will it affect the investment?
No haircut. It depends on what machine they use.
Yeah.
If they use the razor and the comb, that one is deadly.
So yeah,
but that's a good question.
No. I think Bank of Ghana bills, and they buy for the government. So the question will be, what will be the position after the government engagement with IMF on what will be done about the government borrowing. So that would apply to all government. And like I said, the details are not yet out, so it's not good to speculate at this time.
All right. Francis Intema is asking if it makes sense to buy treasury bills or begin contributing into a mutual fund at this time.
I think, I will not be able to answer this question till I have a lot more information from Francis. I mean, I need to know what your investment horizon is, and what your risk tolerance levels are, and which mutual fund or which securities will be needed for you. I mean, if you need your money in 3 to 6 months' time, it does not make sense to invest in a mutual fund. Then you are better off going to buy a treasury bill. If you want to put money away, over the medium to long term, and depending on what your investment objectives are, then possibly mutual funds could be right for you. But one would need further information to answer that question.
All right, this one says, what duration of investments will not be affected by the mark to market? And unlike term deposits, mutual funds do not have a fixed term. So how do they calculate the mark to market?
That's what I asked.
Yeah, I think that's
so let me start by saying that marking to market doesn't affect the value of your investment. What marking to market does is saying that today What is the market value of your investment?
Okay.
Now, how do unit funds or unit trust or mutual funds value or apply mark to market? So, if let's say a particular fund has X amount of investments in GOG bills or bonds, it will look at the prevailing price today, and that will feed into the NAV of the fund. So mutual funds or unit trusts, they are supposed to compute the net asset value of the fund, which is taking into consideration all the assets minus the liability. So it's very simple. It's a question of taking the current value of the bonds that they are market to market, and it shows in the NAV or the price of the fund.
Joshua from Kaswa says, how long is this directive going to be in place? The current value of my investment with EDC is now 80% of 100. Truly speaking, I expect this investment to cushion me in trying times. What is the use of saving now with a directive that values my investment to market value? So that's
for me, I think it's rather unfortunate it's now 80%. But what I'll say is asset prices are depressed. Okay. And there's an adage or maximum fixed income in investments, in investment management, which says you buy when asset prices are low and sell when they are high. So in as much as what we are experiencing is not pleasant, I believe there are also opportunities. So, I mean, but like I said in my previous statement, it's good to look at your circumstances, look at what your investment horizon is, what your risk tolerance level is, and maybe this is the time to even buy more.
I have a question based on what you've said in terms of for those who want to exit, and you are saying if you don't have urgent need for your money, stay. All right. So let's assume I stay because I don't want to distort the market. I don't want to force you because, as you said, everybody is trying to get their money out. So we stay.
You're not distorting the market, it's for your own good.
Fine. So I stay.
Yes.
Are you saying that eventually the market will correct itself and therefore that 100 that become 80 will go back to 100?
Okay, very good question, Bernard. You see, when it comes to equity, I don't want to sound too technical. I use terms like volatility and stuff like that. You see, prices go up and down, which is that's what the fluctuation is called volatility. With equities, the volatility is infinite. With fixed income, once you're holding to maturity, there's a convergence to the face value as we approach maturity. So that is why we are saying stay invested.
Okay.
So something could be 80 now, but once you're getting closer to the maturity date, it trends towards the face value, which is the price when the issuance was done. So maybe at maturity date, you're back to your 100. So you see, that is why it is important that people stay in. Only crystallize your loss in these times when you decide to exit.
Okay.
Now, the thing I was also saying is, because asset prices are trading at depressed levels and you invest more now, there are some of these Government of Ghana bonds which are trading in the high 40s. The yield is in the high 40s. So once you buy some of these securities now, what happens is as you're approaching maturity, over the life of or the remaining life of that bond you'd have purchased, you'd have made some solid returns. And with fixed income, there's always what we call a reversion to the
second question
to come down. And
shouldn't fund managers, of which you are a very good one, begin to question their assumptions? My question is premised on the fact that 2 years ago, when I talked to fund managers, they are like, oh, because of all the things in the financial sector, we are all moving to government. So a lot of our portfolios, we are going to increase the proportion of government things we buy and move away from, because in the past, people were spending money on other instruments. So they were even investing in other financial institutions, for example. So they'll give money to a savings and loans and things as part of all of that mix. And realize actually, because of all that happened in 2017, with some of these companies collapsing, and say, look, let's just move, because there's a diversification as well. So when you give a fund manager worth his salt must manage the assets based on his understanding of the market and his risk. So the guy said, I'm moving the thing to government because government is safer.
Yeah.
Now government, you are saying there's no haircut. We don't know. Definitely, if there's a debt restructuring. What I'm saying is that he's saying that the president said there was no principal haircut, and that even had to be clarified when I asked Kojo upon Nkrumah the question. So I'm saying that don't fund asset managers and fund managers have to re-evaluate their assumptions about the market that government is the safest, government is the best, because there's a risk that the government may not pay. In the past, when they are doing the risk analysis, they always say, for government, the government will pay. But the risk is about interest rate, exchange rate risk, and inflation risk. But now you are sitting here and with an IMF program, you could have a restructuring of domestic debt, and that could mean something else. So I'm just coming back to you to say, maybe we have to get new notes about this market, and maybe we have to tell people that we don't understand it the way we sell it. So when you are coming to give us money, these are the possible things that could happen. He says, so I'm putting it to you on behalf of the industry, not personally. But for me, it's a bother to me that people are unhappy now, and we are now trying to explain the thing reverse based on.
Whereas maybe the explanation should have been done.
And the assumptions they use in the investment were probably wrong.
I mean, those are very extremely valid points, Bernard. And I guess what we've been talking about in the industry is that there needs to be a paradigm shift in our mindset. I mean, once we had a secondary market and there was fluctuation, I mean, I guess especially particularly government of Ghana bonds, there was an element of risk. Okay, so I think the main thing is you talked about diversification. Diversification is key. I always say diversification is the ultimate risk management tool. So, I mean, when it comes to investments, you don't need to put all your eggs in one basket. It doesn't all have to be in government. You should look at equities. You should look at other alternative asset classes as well. But quickly, I think it's also important that investors seem, the mindset of investors always seems to just focus on the upside when it comes to investments. For every investment, and now we are even seeing that with government, there is some downside risk. So people need to know that, there's upside, there's downside. Just don't focus exclusively on the upside, because that is what seems to happen, and then people go ballistic when they're losing money.
I guess the fact that it's money and people want more of it.
People get emotional when it comes to money.
Nathan, I think we need to conclude with a question for Rev, in a sense. A lot of people keep asking about the previous revocation and their debts and things. I need you to make a statement on that. For example, somebody says, Bernard, first fund since its revocation in 2019, shareholders have been paid just 8% of their investment. This was paid in 2021. What is the S.E.C doing? I believe that, yes, you are here to talk about mark-to-market and all of this, but I believe there are unresolved issues with the 2017 to 2020 financial sector cleanup, where some of the customers in companies that you regulate have still not received their money. And I believe it's important for you to make a comment on that. Is it that the money is finished? Is it that they will be paid later? Is it that when the IMF comes, we don't know. So please, you need to give us some way forward on that matter.
So is that the last question? Or you're
no,
going
that's the one. We have only 5 minutes, so that's what people are sending me. So I have to ask you.
Okay, so I think the clarity is that for investors who had their monies in some collective investment schemes managed by the failed fund management companies, what the S.E.C did was to basically engage the boards of the mutual funds or the trustees of the unit trust that engage new fund managers, because the revocation didn't affect the licenses of the fund. So if you take a first fund or any of the mutual funds or the unit trusts that were being managed by those fund managers who lost their licenses, those schemes, collective investment schemes, were still intact. So the direction from S.E.C to the directors, because the directors are responsible to appoint new fund managers. So we are aware that the directors have gone through various processes, to basically engage new fund managers. Some had to, after agreeing on one, then the fund manager came back and said, "I'm no longer interested." So some had to go through multiple processes to have new fund managers appointed. Now, when the new fund manager is appointed, the new fund manager also would need to do an assessment of the portfolio to determine where the assets are, what is the state of the assets, and then engage the shareholders or the investors in the mutual fund or the unit trust about the way forward. And like any mutual fund or unit trust, the investments are not guaranteed. I think that is a point that people must understand. If you invest in a mutual fund or unit trust, your investment is not guaranteed. Okay, so it depends on what assets there are in the fund and the ability of the fund manager to sell the funds. So we are aware that some of the collect investment schemes, in this case, the fund managers are having difficulty because of the underlying assets. But what I would say is that the investors in those funds should be patient and engage the fund manager, to give them updates on what is the exact state of the assets of the fund and what they are doing. And if they are still not getting that clarity, they can file a complaint at the S.E.C. But what we did was to get the board of directors and the trustees to appoint new fund managers. That is what the law requires. So that's what I'll say. But maybe just to touch, I can see one question a bit on liquidity.
Yes.
And I'll just touch on. I'll just touch on it. Yes. So we are aware that because of the heightened redemptions and the fact that the secondary market has become very dry. The secondary market has become very dry because I think a lot of people are in a hesitant mood or wait and see, not sure of, as it were, what would happen with discussions on government debt. So you find that the appetite to buy in the secondary market is not there. So a number of the fund managers seem to have a serious liquidity crunch because of the heightened redemptions as well. They have exhausted the provision they made to meet liquidity and they're having to sell. Meanwhile, there are no buyers, no takers on the secondary market. So it's not an issue of maybe some fund managers have done the wrong thing, but the issue is they are invested in government of Ghana bills. They are willing to sell, but there are no takers. So there is a bit of liquidity. We have been engaging with various stakeholders, including the Bank of Ghana, and hopefully there will be some liquidity that would help the fund manager. So again, we just ask for people to exercise some constraint, ask questions, and then get understanding from the managers of the various schemes.
Great. Thank you so much. We've been speaking to Reverend Daniel Ogbarmey Tetteh. He's Director General of the S.E.C, the Securities and Exchange Commission. Then we also had Mr. Kise Antonio, Vice President of Ghana Securities Industry Association, and he's the MD of Sentinel Asset Management. Gentlemen, thank you so much for coming. I'm sure at least some people have some clarity now. There will be those who will still ask a few questions. But Reverend, just quickly, if somebody wants to get in touch with the S.E.C, how can they do so?
So our website www.sec.gov www.sec.gov.gh.
Okay.
sec.gov.gh. You can go there. You can send an email to info info at SEC .gov.gh. Send a complaint, and then if you go to our website, you'll find our toll-free number, so you can call without it costing you. So these options are there. You can engage us if you have any further questions on what is going on in the market. But we remain committed to protecting investors and the integrity of the market.
Rev, thank you so much. That was Reverend Daniel Ogbarmey Tetteh. He's Director General of the SEC. We also had Mr. Kisia Antonio, Vice President of the Ghana Securities Industry Association and MD of Sentinel Asset Management. Just talking about mark-to-market and all that's happening. So I'm sure you have some info now. And like you said, you can get in touch with the SEC, info at sec.gov.gh. That's the email address. You can send and get all your questions answered.